Yes, guys and girls, welcome back to another BMO video. Today we're going to be looking at direction of the data surprises. So this is quite an important video, if you will. We've seen this be very prevalent, especially over the last sort of 12 to 18 months for sure. And that is something we are going to continue to monitor, especially during your trading career. You're going to see this be very, very, very prevalent. So direction data surprises is obviously self-explanatory. How does the data surprise relative to the consensus? Now, similar to the reaction function video, which of course is before this, the direction of the data is what the market cares about. They do care about the level that the data is at, but if the trend of the data starts to point down, for example, this would likely encompass a weak currency as well. So of course, if, for example, the US's data, the data or Europeans data, for example, is actually a good one where European data turned from positive to negative. And that was a level where the European data was getting good. And then we start to see that shift and then turbocharge the downside, or the data started to turbocharge to the downside. We saw that got weaker and weaker and weaker and weaker. And then the markets were selling euro in that environment because it's a new surprise, right? It's important to follow the data that the market cares about. So, of course, known as the reaction function, which, of course, is the video before this. So, obviously, we know how to understand it is obviously just look at what does the market react more to. Does it react more to inflationary data on upside surprises? Does it react more to growth data, for example? And of course, that fits in with the theme as well. A trend will only be classed as a trend if we see a couple of months worth of the same direction, but also if the other data begins to follow suit. So, of course, you can't just say, weak growth data or weak NFP in the US, now we need to fully sell the dollar. You might go tactically short the dollar in the near term because it's a new potential trend forming, but you can't class it as the markets are now, or the labor market is now trending lower in the US if you're not seeing the other bits of data and you're not seeing a bit more worth months of data, because you can't just state a trend is happening if you're seeing 1 month's worth of weak data. If that encompasses and everything begins to follow suit, then yes, you could argue that is a trend, and now that's a reason to get massively short the dollar. So as we've mentioned, you're going to learn about, or you are going to learn the short and long-term themes, tactical plays. But for now, just think about that for sure. Is a trend is only classed as a trend if you do see a couple worth months of data, but also if we see the other data start to follow suit as well. Trending to the upside. So if the data is trending to the upside, this would suggest likely that the economy expanding, inflation is moving higher, and as a result, what do you think? The central bank is likely to be more on the hawkish side. And that is going to mean what exactly? Well, if that happens, data's good. Let's say growth data is really good. Inflation is moving higher, surprising to the upside. So clearly what that means is the markets are under evaluating where the data is, shall we say, and they're seeing that the US economy is not as fast as what they saw in the data, for example. That just suggests that actually, the economy is expanding a lot quicker than we initially thought. And that's something new for the markets. The markets trade the direction of the data surprises, not necessarily the level it is at. So that's something to know. The markets care a bit more about where the direction of the data is going in each country, because now that may mean that the central bank at the next meeting is likely to be dovish or hawkish, for example. So consider the direction, not necessarily the level, because you could argue unemployment rate is really low in pretty much everywhere in G10. Well, that's not a reason to get bullish the currency if the unemployment rate is low. It's happening everywhere. It's not really new. And also, if we start to see labor market contract in, let's say, Europe, you might now mean, or let's say the data in Europe is showing downside surprises in its labor market data, you could argue now unemployment rate is going to rise, and that's going to be generally bad for the currency. So you have to consider the surprising the direction, or the data direction, rather than the level. Level, as I mentioned, is important, but please consider the direction. You can use this framework to see where divergences are forming and have a much better idea of which trades to take. So of course you can do exactly the same. So do euro areas data surprises, growth is doing this, labor market or employment is doing this, inflation is doing this, for example. Then do it for the US and do it for the pound and do it for Aussie, CAD, etc. And then you can see a divergence or a likely divergence. And a common indicator that's used by the market is known as the City Surprise Index, which is this one over here. And this shows the overall trend of recent data. You can just look at trade and economics or Forex Factor, for example, for a gauge of directional data or directional surprises. The issue with this is it does encompass a lot of data, and it doesn't necessarily mean the direction of this data in this chart represents what the market cares about. So it's always important. So you can look at this because it's give a gauge of an overall trend, but a massive downside surprise in, let's say, current account is going to outweigh the upside surprise in the labor market, what the market cares more about, if that makes sense. So you have to basically just look at it as an overall. Don't gauge that this is reason now to get short or buying. It's just a good indicator to use just to see the overall health of the economy. And what this shows is if the country is surprising to the upside relative to the consensus figure. So what that means is markets expect inflation to come in at 2%, comes in at 2.4%. That's an upside surprise. Previously 1.8, for example. That's an upside surprise. That's what that means there. And of course, yeah, as I mentioned, this is the US City Surprise Index. What you can do is just go into Google, type US City, or just put City Surprise Index into Google. I think the one I was using was macro beat, something like that. Macro, something like that. And that was the chart I was using there. So that's just an example of trending to the upside, and it is important to understand that the surprise index should only be used as a reference point and not a tool for choosing the trades to take. For instance, while the US index has been steadily positive for a while, Europe's index has been recovering from negative territory since August. But does that mean you now want to be long euro dollar? Well, since August, euro dollar has been selling off. So it's important not just euro area is now trending up. That's something new. Markets, that might be because of other bits of data that's pulling that index higher, not necessarily the data that the market cares about. And if you see a trend emerge in the US where employment data starts to under-deliver, that may be an opportunity to start to position against the currency, as it now means the Fed is more likely to cut. But at the same time, you will have to consider the market's theme at the time. So obviously, that theme is logical at the moment, where if employment data starts to fall, you're now going to be selling the currency. That's fine. But we're going to get to a point where the market will switch the theme, where everyone's just been speaking about is employment week and growth week, inflation week. It gets to a point now where that begins to change. We'll have to see what that changes. Of course, this is why we just keep up to date with it. But that's just an example there. And ask yourself this question: which way is the data trending, and is the market on board this idea? This is really important. What I mean by that is, well, if the data surprises is going down in, let's say, euro, in the euro area, well, that's an example and the reasons where now the markets have something new, in quotations, to price in. Does that mean you're going to get bearish the currency? Maybe. You now have to ask yourself, is the market on board this idea? Basically, what I mean by that is, does the data support that narrative or not? Does the data support the theme? Does the downside surprise support the idea that the ECB is going to cut sooner, which is the theme at the moment, for example? If it does, great, another reason to get short the currency. So that's just an example there. Think about the direction, remember, not necessarily the level. So here's an example. In September, the overall trend of the US data that the market cares about moved higher. For labor market data as a whole, it surprised to the upside, and inflationary data came in at choppy conditions, where we saw some upside moves in CPI, but downside moves in wages and core PC deflator. Overall, though, the trend was positive for the US when compared to the euro area. The euro area's data in September showed consistent downside surprises in employment, growth, housing, and PMI data, as well as lower than expected inflation compared to the US. So remember, markets care about the direction of the data rather than the level. That's really, really important. And of course, you can apply this framework to all currencies. You don't just do it for the US or euro, do it for the Australian dollar, do it for the Canadian dollar. And then, again, remember, care about the data that the markets actually care about. So what is the theme? Does this data support this theme or not? If you're looking at, let's say, government debt to debt ratio, markets don't really care about that at the moment. That might be a theme next year or the year after, who knows? We'll have to wait and see. But for now, markets don't care about that. So you just neglect that data until the markets begin to pick up. And you'll know is if that comes in weak, remember the reaction function. If we see like a really weak government debt ratio data, for example, and the market really sells off, then that kind of tells you that maybe the markets are starting to notice this. And that's something to consider in the future. And of course, you have to consider what other asset classes are doing, sentiment, etc. as well. You don't just say, okay, direction of data surprises doing this. To be fair to you, though, they all tie in together. For example, if the data trend for the US is positive, well, that means likely the Fed is going to hike again, or the markets will at least price that in, and that's going to be good for the currency. Then you could also suggest that maybe rates climb higher, so the bond yields basically climb higher. That's going to pull the dollar higher as well. Maybe equity markets sell off because another rate hike is going to maybe hurt valuations for companies. And of course, they generally move in opposite to each other, equities and currencies. So yeah, those are just examples. You have to consider what other asset classes are doing as well. Remember, trading is not just about looking at the data. It's also about looking at other asset classes as well. And here's just an example of that data surprises in Europe. This is euro dollar since September to, of course, October. 1st of September to the 1st of October. Data, as we've mentioned here, this one here, growth, employment, housing, and PMI data are all pointing down, and of course lower than expected inflation when compared to the US. And what does that mean? Well, likely then the ECB is going to hold a lot earlier, maybe cut a lot sooner, etc. When compared to the US, well, then the direction of that was just pointing down then, wasn't it? Now, of course, trending to the downside. So here is an example of trending to the downside in terms of the data. Similar to upside surprise, if data is trending down, this suggests that the currency will likely weaken as well. But as we know, it's not always as simple as that. The markets will be trading in this direction as it will influence policy, the mindset of the market, and other asset classes as well. You will be looking at the same data as the bank, so ideally, you should get roughly the same idea if interpreted correctly. So of course, what I mean by that is everybody looks at the same data. We'll all access the same GDP data. We'll all access the same claimant counts, wages, CPI, monetary policy. We'll all access the same regardless if you work at an institution or if you're a retail trader, you've started yesterday, you're going to have access to the same data. It's about how you interpret that. That's the important perspective. Some people might interpret it slightly differently and then they'll have a bit of a different currency view. That's fine. Because that's, both arguments probably sound valid if you put them in a context, right? But here's just an example, right? Where we had, of course, this is September's data. I put on the main bits of data that the markets cared about. And as you can see, we had some choppy bits of data. Wages increased. Claim accounts got better, okay? So clearly that's a relatively decent sign at that stage there. Then we had GDP going to negative territory. So it's choppy. Then we got to the main bits of data. So obviously this is really key anyway. This is always important bits of data you see. But you can kind of see the overall direction if you just look down on the left. It's been pointing negative. Inflation came in way less than consensus. Core CPI came in way less than consensus. Monetary policy under-delivered. They're expected to hike, but they held. Retail sales coming in even more or coming in less than what the forecast was saying. Downside surprise, remember. Services PMIs, downside surprise. So you can kind of see that the contraction in the important data sets. Now, you are going to have volatile components like I've just mentioned here, but that's important to see how does the market react going forward, for example. So this is just something you should consider after this. But if the markets are looking at, okay, claim accounts are good, wages are good, but now we start to see all of the other components contract, they're going to probably put more weighting onto these than this, for example. And then, of course, this is just GU as well on the way in since September all the way down to the 1st of October, selling off. But then if you also consider what the US was doing in terms of its data, surprise to the upside, inflation data came in slightly choppy, but the overall trend was relatively decent and positive. Labour market was, again, good. Then compare that against the UK. Well, that's night and day trades, right? GU to the downside. Now, you, of course, compare XX, so USD, versus GBP's or the UK's data surprises. This is really important. So what you do is you just get up, similar to what I've done here. You can either use Trading Economics or Forex Factory, whatever you want to use, but get it up for the month and just monitor. So monitor what you should do now as like a little bit of homework, if you will. Sounds a bit bad, but homework is you could go out and do it for Canada. So go into September and look at how does the data surprises do for Canada. How did the Canadian dollar react? But then also remember what the markets care about. Also consider what other asset classes are doing. For example, CAD might be rallying really aggressively, even though downside surprises are happening because of oil is pumping higher. Because you also have to consider other asset classes, not just what the data is doing, but also other aspects as well. Like here, what's the mindset of the market? What are they all talking about? What's other asset classes doing? But generally, they would all point in the same sort of direction. Oil is very volatile. Naturally, rates aren't going to do anything to it. But that's in terms of equities and, of course, rates. They are very sensitive to any changes in data. So, of course, remember, just do the same thing. Do the USAs, do the Europes, do the pounds, do the Australians, Canadas, New Zealands, yens, the Swissies, not Sweden if you want to trade that, and you look at them and then look at the direction of the surprises. But look at September's, because we have all of September's data now, and compare them and say, okay, based on the surprises alone, how did the currency react? Then all you do is just look on the chart and say, oh, look, if I was trading through September, I understood that data surprises were pointing down. I might have wanted to have a bit more of a bearish outlook on that currency when in reality I was just buying it, for example. And I was neglecting the surprises of data because of the changes to policy. So hopefully that's a bit more sense on just data surprises. Very simple though, isn't it? You know, we're not going to go into a lot. All you got to look at is how is the data surprising relative to the consensus. And as you can see, most of the UK data pointed negative. The ones that people cared about. People who don't care about manufacturing, they didn't react to this, but they reacted to services. Consumer confidence. At the moment, markets don't care about consumer confidence. We're not seeing too much reaction from consumer confidence. Markets care really about inflation, care obviously about what the BOE is doing. They also care about GDP, unemployment rate, naturally earnings, average hourly earnings, and claimant counts. Well, claimant counts could have only got better because of a certain perspective. So this is why it's important to look at the underlying data as well, and not just consider the headline. But overall, yeah, it was all pointing down for the pound, and as a result, the pound sold off basically since September. So yeah, you can do the same thing here. Screenshot them for the UK and the dollar and the CADs, and then just compare. So that's it for today's video. I'll see you in the next one. Take care.